Howdy, Jacob here. Today we're looking at the company CBIZ in the professional services industry. 4.2 billion market cap on 4.6 billion enterprise value. They provide financial, insurance, and advisory services in the U.S. and Canada. Headquartered in Ohio, incorporated in 1987. Let's say it's a non-for-profit. The company primarily serves small and medium-sized individuals, government entities, not-for-profit. Okay. Growth is pretty impressive, over double revenue over the last 10 years, with gross margin and operating margin increasing. Return on invested capital also increasing, almost 10%, likely above their weighted average cost of capital. Very positive on really all fronts at this point. Balance sheet shows 8 million in cash, no short-term debt, 311 million long-term debt, no cash, but that 311 million long-term debt is less than 3 years of their 5-year average free cash flow. So we're not terribly concerned about it. Again, just in case things go absolutely crazy, I prefer a bit of cash on hand, whether you're an individual or a business. But for this company, they've made in the last 10 years their lowest free cash flow is $39 million. So I guess we're really not concerned about it. And use of cash is pretty heavy on the share repurchases and the acquisition side, and a little bit on the reinvestment side. So I think we're ready to make some assumptions here. No need to blab about anything else. Revenue growth has been very good the last 3 years. I think I'll probably be more comfortable with maybe a 6%. So again, you do have inflation, but then the company's also going to make some acquisitions here, and I think that's going to be reasonable for a 6% increase in revenue. For margins, free cash flow being higher, free cash flow being higher always makes me happy. Let's do 8 and 9%. With share change, 1% would be about 40 million, 50 million to offset stock-based compensation. I think I feel good about that. Terminal PE of pretty much market average. I don't see anything wrong with that. 15% return here. So we're saying with our assumptions, the company's stock price needs to fall 71% before you get the return we're looking for here. Again, I think it's a great company, but every investment, or almost all investments, are the present value of free cash flow. And for me here, I don't think that they're there yet. I think the 33p. I think that their growth is not going to be able to outsubstantiate the discount rate that I'm looking for, and I do think you're going to get some depreciation in that price to earnings and price to free cash flow. So for me, at this point, I will be waiting and viewing other companies, researching other companies in the meantime. I hope you enjoy the video and have a great day. Thanks.